Before we start this week's podcast, I'd like to say a quick thank you to our podcast sponsor, PensionBee. Now, PensionBee is one of the UK's leading online pension providers that helps consumers combine, contribute and withdraw from their pensions, all through the PensionBee web and mobile app. Now, you can sign up with the names of your old employers or providers in just 5 minutes, and PensionBee will help you find, transfer and combine your old forgotten about pension pots into a low-cost online pension plan. Now, these are managed by the likes of BlackRock, State Street Global Advisors, Legal & General or HSBC. Now, they have over 250,000 customers that have already signed up to combine their pensions with PensionBee, combining close to £1 billion into their plans. You can also find out more information about PensionBee at pensionbee.com, and as always with investments, your capital is at risk.
Hello and welcome to episode 254 of the Money to the Masses podcast with your resident expert as always, Damien Fay, and me, Andy Leeks. Damien, welcome back. How you doing?
I'm good, Andy. Very good. We've got the cricket on in the background, I've just noticed, as we're doing the podcast. Not that we're distracted in any way, but
we're doing well, but by the time the podcast comes out, we may well all be out and game over.
Game over. So I've been learning about cricket via the Money to the Masses offices in the last year or so, but I'm good. I'm excited this week. The Facebook community has been buzzing, which I really enjoy. So although I'm in the background, very much so in the community, I watch everything, read nearly everything. So it's great to see it growing. We talked about it last week and we ticked over 1,000 people, and within days we got to 1,100. Let's keep growing the community, keep people coming, invite them, because you can invite people to the community, of course, and it's a great place to ask questions and get them answered. And the other thing I just want to mention that I love that spiraled out of that was Money to the Masses Pets. Yeah. And we talked about it, I think, on a previous podcast, but we've had more pictures of pets, and it went onto our Instagram and sparked a whole wave of new animals to be included in our MTTM Pets hashtag. So that's been fantastic. And the other thing I just want to mention before we crack on with the podcast is there is a chance for you to get a Money to the Masses mug. Now, we've not done a giveaway for a while, and if you post a review, if you've not posted a review, in fact, I know you can post reviews more than once, people have told me, but if you want to post a 5-star review, I can't probably say make sure it's 5-star, but if you post a review within the next week, by the time the next show comes out, then you will win a Money to the Masses mug. So to do that, post your review, do email Lauren at moneytothemasses.com with your Apple iTunes tag that comes up in the review and say that's you, so you can send her an email with your name and address, and then we'll make sure you get the Money to the Masses mug.
And actually on that, there are other things that people listen to podcasts on. I think there's lots of different apps. I use one called Podbean, for example. So I think we should extend it to review it. If you post your reviews on those apps, screenshot it and send it to Lauren, because it's still a review and you're still letting people know.
Well, however you promote it, I love that idea. We've not done it for a while, so I thought we're going to get some more people on the Mug Wall of Fame alongside their pets. We're thinking of adding the pets to the Mug Wall of Fame. So do send them in. It's great for promoting the show and pushing the show up those iTunes charts.
And the mugs are great for your coffee.
They're great for your coffee. So
what do we got?
What on this week's show, we've got 3 pieces. Now, this is something that is quite close to home in a way. If you're pondering having to move relatively quickly from where you live now, so you're a homeowner, you own your house, and you're thinking of maybe moving the area, it could be something because of schools, you could be getting married, you could be a couple with your own properties. A way of moving more quickly. So it's called let to buy mortgages. I'll come on to that. It's not buy to let, it's let to buy, and I'll explain that. It's something that a lot of people won't know exist, and it's something that will be of interest to them. The second piece I want to talk about are interest rates. Now, I never try and time date this podcast ever, but this week there's been quite a move. I mentioned it on midweek markets about interest rate expectations, but I know not everybody listens to midweek markets, but I want to talk more around when interest rates are expected to go up or down. That means your mortgage rates go up or down. I'll give you a hint. The market is suddenly thinking interest rates are going to go down. And the final piece I want to talk about is whether you should invest if the market's about to collapse. Now, I had a question there's somebody who's written in who is worried about the market going to collapse. So I'll touch upon it at the end about whether now's a good time. It's something that we cover every now and then periodically, particularly when markets are at all-time highs. We get a lot of people get quite nervous about investing, and so I want to allay their fears, as it were.
Great. So a lot of people have heard about buy-to-let mortgages, but less have probably heard, in fact, I'm not sure I'd heard about it, about let-to-buy mortgages. We're going to explain what they are and when they can be useful.
Yeah, so let's give a scenario, for example. I always like to bring it closer to home so people can understand it. So take me, for example. If I decided I needed to move very quickly to go somewhere, it might not even be necessarily the idea that I need to go within a very short space of time. It may be the market's being a bit sluggish, so the property market. What normally happens is people, if they own a house, they will sell their existing house and buy a new one, and that transaction will go through. And it can take quite a period of time. If you want to know that, you can just come and talk to Justin in the office.
Yeah.
The next time we have a meet-up, do not mention house purchases, probably around them people with money to the masses. We've had enough of them in the last few months. But there is a way of you being able to still move, even if you're struggling to sell your house or you aren't able to sell it as quickly, and it's through something called a let-to-buy mortgage. Now, the idea behind it is you end up taking your existing property. Now, I'll call it the old property while I'm doing this piece. So hear me talk about the old property and the new property. So your old existing property, and what happens is you essentially take out two mortgage products, and your existing mortgage gets turned into a type of buy-to-let mortgage. And then usually with the same provider, you will take out a new mortgage to buy your new property with using the equity that you've released from the old one. So some of the equity. I'll run through some numbers a bit later to give people a steer, but it's not a case that you just release all the equity, because there are implications of selling a house. And what happens is the idea is you then let out your old home to somebody else. They will rent it, and then you can go and buy a new house, and you end up having two properties. But what you've done is you've been able to move far more quickly, because essentially you just bought a new house without having to sell the old one. So the problems of a chain don't exist. Now, I gave a couple of examples why you might want to do it if you want to move quickly. Like for me, I might decide I want to move areas and go to a different area because of schools or something like that. It could be a whole range of reasons. It could be somebody's job. Another one is if people are couples and they both own property, and they may have both had houses independently, but they then decide that they want to move in together, and therefore they both own a property each, but they decide they might want to go and buy another one or move into one of them. And so it can help them, because what they means they can do is they can keep an old property but release equity to go and buy a house together.
It would also probably help in a situation where that dream property has come up on the market. You're not quite ready in a position to sell yet, but you don't want to lose that property.
Yeah, that's a really good one. So that's probably one of the best examples. If you've gone somewhere, you found your dream home, you're under pressure to be able to buy it quickly, but you're not able to sell your property quickly, and you think, well, I just want to be able to buy that home. This could potentially be a route for those people. And the other person or people it might be for is if their current property has dropped in value. So we're not talking about completely through the floor, because they're going to have to release some equity and they want to release as much as they can, but the value may have dropped, so it's not as much as they'd hoped for. So it still means they may be able to move. So for these people, you still need a decent amount of equity in your home. So with your let-to-buy mortgage, what happens is, as I said, the existing one will go on to a type of buy-to-let, and that will allow you to release equity. Now, there are key criteria to it. So you can only have 75% of the value of the property. So let's say you had a property that was worth £300,000, then the maximum amount of money that you're going to be able to release in terms of equity from that is going to be about £225,000, because you've got a buy-to-let mortgage on the property, but it's only for 75% of the value. The difference between a buy-to-let mortgage and what we're doing here is a buy-to-let mortgage is someone's going along and saying, I want to buy this property to rent it out. Whereas with the scenario we're in, you say, I've already got one and I want to just rent it out. And don't forget, that when you have a mortgage, a residential mortgage, the terms of that mortgage will state that you can't use it as a rental. You can't let it out.
So tell that to the 20,000 people that are in the country currently doing it.
Yeah, there will be lots of people who are on the podcast now have just turned that bit down and go, well, we'll gloss over that. And I'll come back to that bit at the very end of the podcast because it's the alternative section for this piece. So you end up with basically effectively a buy-to-let mortgage on your existing one, and the rates are similar to what you'd get on a buy-to-let. And as I said, our criteria, you've released that equity, there's a max age of 70, and you have to have evidence that the rent that you can get on your old property will cover the new buy-to-let mortgage on that quite comfortably. And it typically, one of the figures is about 125% of the mortgage itself. And of course, they may want you to be able to show that you can cover void periods. Plus, you'll need to provide the evidence of the future house purchase.
So in simple terms, if the mortgage was £1,000 a month, they'd like you to be able to gather rent for about £1,250.
Yeah, but what will happen is, to give people some context, it depends on where you are and everything. But let's say you had a mortgage that was £1,000 a month. Yeah, we're talking about you in London somewhere maybe. You may be able to convert your property into this buy-to-let while you're doing this let-to-buy process. And the buy-to-let mortgage might drop down to maybe £400 a month. It may drop down to a much smaller amount because don't forget, you're only getting 75% of the property value that's being part of that mortgage that's being released. So it means that your rent could comfortably pay and cover the new buy-to-let mortgage. And in fact, there are people where this has happened and the amount they can get over and above it could even go towards the new mortgage because don't forget, on the new property, you're effectively getting a new residential mortgage on that property. The difference can go and pay towards that mortgage as well because you're making a profit. Now you've got to take into account the fact of fees. So there's going to be maintenance, there's going to have to be legals, insurance, all these things, these responsibilities you have that eat into any profit you have. But the process is meant to be, it allows you to become a landlord. Maybe you didn't really particularly want to, but it allows you to move further forward. It gives you that flexibility. Oh, and another thing, it's usually an interest-only product. Now, the example I want to give is if you imagine you had a £300,000 house and you were, say, a couple, you were married and you earned a decent income together jointly, let's say it's over £65,000, then if you decided to go down this let-to-buy mortgage route, what would happen is you could say take 75% of the existing value, which brings that down to £225,000. You get the buy-to-let mortgage on your old property, £225,000 is pulled out. Now we're assuming you've got £100,000 mortgage on that old property, just because it's your house you've been living in for a long time. You built out a nice bit of equity in that property, so the property was £300,000. Remember, you've got £100,000 mortgage left over. So that 225 that's been released by this buy-to-let that's been put on your old property, you then have to take £100,000 out of that to pay your old residential mortgage. So that leaves you with £125,000. But of course, now you're going to go and try and buy a new property. So you've got to allow for stamp duty, you've got to allow for fees, like solicitor fees, etc. So let's say if you were trying to buy a £400,000 property, then you would probably need to allow at least £25,000 for that. And one of the things to bear in mind, the downsides of this route, is that you're buying a second property. So you're going to have to pay the additional stamp duty rate, the 3% on all of the bands. There's an additional 3% rate that's added on top of that. So in my example, I've allowed for that. So let's say you had to allow £25,000 of all the money that you've got out of your old property. That would leave you with £100,000. And that £100,000 you could then put towards as a deposit on your new property under the new mortgage that you're going, the new residential mortgage. And so typically you have to have something like a 25% deposit. So in my example there,
you've just about scraped
it, and you would have got your £400,000 property. Now, where this will work for some people is that if you imagine that maybe you lived in a town and you decided to move out somewhere further out, you've technically got a property that's more expensive, but you're probably going to get more for your money anyway because you've moved somewhere. Maybe you want to move out somewhere quieter. Maybe you've been in central London, you want to move further out. So you get more for your money anyway. You've got a slightly bigger property, but you've also got this buy-to-let that could potentially be helping to fund the mortgage on the new property, even though your mortgage will be slightly more. Now, there are obviously downsides to all of this. It's not all a bed of roses. You've suddenly got two mortgages you're responsible for. you've gone from one mortgage to two mortgages. That's quite a responsibility. You've got the stamp duty charge. And now there are rules that if you sell the old property within 36 months, you can then claim back that additional stamp duty surcharge, the top bit on top.
And that was kind of devised, I imagine, for people in this situation that were doing it as a short-term measure and not necessarily. They were almost like forced into it because of this situation.
Yeah, it's not.
They didn't want to be landlords.
Yeah, it's not about the let to buy process. It's about people who the government wants people to be mobile, and if people couldn't go and move around, say from the north of England to the south or vice versa because of a job, then it starts to impact the economy and productivity and jobs. So what they wanted is not to penalise people who suddenly had to move house and took a while to sell their old house.
Yeah.
The other thing you've got to realise is that let to buy rates are higher than normal residential rates. So because you're getting a buy to let mortgage, the buy to let rate and the whole let to buy thing, the rate you'll get there is going to be higher than a residential mortgage. It doesn't mean they're going to be terrible. You can get 2-year fix of about 1.35% depending on your circumstances and deposits, etc. But there are still some good deals. The other downside is that there are only 20 providers who do this whole process because it's slightly convoluted. So you might get somebody like Nationwide or someone like that I've seen who do it, and they might have this whole let to buy process where they allow you to release the money to go and get another residential mortgage with them to go and buy the second property. You've got to realise that you're on the hook for any falls in house price times 2.
Yeah.
Now, people might be sitting there thinking, yeah, but you've also, on the positive, if markets keep going up, if the house prices keep going up, it's double bubble. Yeah, you're getting the growth on 2 properties. That's the positive. But I've got to tell people what the downsides are. Of course, you've also got the idea of capital gains tax potentially on the first property because it's no longer your primary residence. So you don't get the full relief on it. So a portion of it is going to be potentially subject to capital gains tax depending on the timescales when you sell it. Because if you sell it fairly quickly after you've moved out of it, then you can still get the full relief on all of it. So you go and look at primary residency relief online and you'll find out the full details of the rules there. I'm not going to go through it all now. And of course, all of this is going to be subject to lending criteria from the mortgage lenders. So the example I gave earlier was just a general example, but your income is going to be assessed and your affordability checks are going to be made. So it might not technically work, even with all those numbers I had, that was an example, but you're therefore going to be under scrutiny. And anyone who's bought a house recently realises how onerous all of that is. Now, the alternatives, of course, are if you're in that scenario, you could just rent and rent. That's a possibility. You're not doing any of this stuff, so you need to move quickly. You could rent out your old house and just rent a new house. So that way you still stay on the property ladder and in the property market. But the problem is you technically won't be allowed on a residential mortgage to loan out your house, to let it out. So what you need to do is, if you're going to do that, you need to speak to your lender and see what they say about it. They may be okay. They may end up changing your product. You need to speak to your lender to find out the solution, but you need to tell them, otherwise you're in breach of that contract. And of course, the other alternative is you end up remortgaging your existing property and turn it into a buy-to-let mortgage, and then you just rent somewhere else. So the point is, this process exists, and could be a little bit of a lifeline, a little bit of a chink of light in a dark tunnel for people who suddenly sitting there looking at it and thinking, we're going to have to move relatively quickly because of something. I'm not sure how we're going to afford to do it because of, or be able to do it logistically. This process exists. Speak to a independent mortgage broker who can talk you through who can do this. But let to buy mortgages, the whole process exists. And to show the popularity, according to some news that I read, there's been a 15% rise in the last 6 months of people using this. And I think some of that is down to the sluggishness of the property market over Brexit, where people want to buy the next house and are finding it difficult or worried about selling their existing property, and they're using this to end up being temporary landlords.
Quick question on that. If you're going through this process, you're effectively turning one product into 2. Would it be the same lender that offers the 2, or will you be split off and have to go to 2 different lenders?
Now, I've only seen it where the same, like I mentioned earlier, Nationwide will do the same thing where it's with the same lender. And I was doing a lot of research around it, and there were suggestions from one broker that you could have separate lenders. I don't know if that's the case because I've not seen it. But if you speak to a mortgage broker, they'll do it for you. But it will be almost inevitably far easier if you have the one lender. But it does, as I say, you've got a very, very limited range. There's only 20 providers out there who even will do this.
Okay, so moving on to interest rates. We touched on this briefly in the Midweek Markets podcast, and it's interesting what's going on about it. There's a lot of talk about it. We don't like to date the podcast, but it's definitely worth talking about it.
Yeah, so people might not realise there's lots of stuff we do at Money to the Masses, whether it's Facebook groups, newsletters. So again, another one is our newsletter on a Sunday. We compile a newsletter that goes out to thousands and thousands of people every Sunday of all the key stories in the week about all range of things that might affect your finances. So it's normally stuff it's not just newsy, but it's stuff that will perhaps impact your finances, about rule changes, about something that's happening out there, maybe about new products, whatever. It's stuff that people, they like it for the serendipity-ness. We split it into stuff to do with maybe a bit of money saving, to do with investing, pensions, property. All those sections are covered, and people don't realise we do it. And so we never sit there on the podcast and say, sign up to the newsletter, go to moneytothemasses.com/newsletter. Because one of the things we do on there is on the Sunday morning, somebody gets up, it's not me, I'm going to admit that straight away, gets up and goes through all the Sunday papers money sections and pulls out the key stories from them, compiles them into a single post where you can just click through and start the key stories. They also do it for the property sections. So we never talk about it. We just assume people find it by osmosis. So there's all these things that we do. And one of the things I do every month is I always write an article completely separate. It's on the website about when will interest rates go up. Now, I'm not crystal ball gazing. I don't know exactly when, but it's to give people a steer as to what the market is predicting about when interest rates go up. Because I appreciate that when you're trying to take out a mortgage or make a decision on buying a house, one of the key things is people go, well, should I fix my mortgage or not? And if I fix it, how long should I fix it for? And one of the key bits of information you need to make an informed choice is what's going on with interest rates. And so what I try and do is teach people about the key facts that the Monetary Policy Committee, which is the 9-strong committee that at the Bank of England that makes a decision. It's not every month actually anymore. It's only 8 times a year. They meet up, so nearly every month, to make a decision whether to keep rates where they are, raise them or lower them. And it's a majority vote. So at the moment it's been 7-2 every month for the last, I think some point last year, where they've kept rates on hold, but 2 people are voting for an interest rate cut. So that gives you some insight maybe where things are going to go. So will the Bank of England base rate go lower? It's at 0.75% now. If it goes lower, then anyone who's on a tracker mortgage is likely to have it, well, it will fall if it's tracking the Bank of England base rate. If you're on a standard variable rate mortgage, your interest rate won't necessarily fall when they announce a cut, if they did, because it's up to your lender. It's not directly tied to the bank of base rate. They've got a discretion. And of course, people on fixed mortgages for whatever term, doesn't matter what the interest rate at the Bank of England is doing, you are paying a set rate you'd agreed for a period of time, maybe 2 years, 5 years. Of course, all of that is on the flip side if rates go up. That's why the benefit of fixing, if rates suddenly rocketed, you don't have to pay more on your mortgage. So I look at what the market is predicting based on what they're pricing in about interest rates and where they're going to go. Now, if you go back to April last year, they were predicting that we would have a rate rise by the end of 2019, a 1 in 3 chance that would occur. Now, they obviously got that wrong. There wasn't an interest rate rise, and that's because this is such a moving target. There's so many parts to this. It's not just our economy, it's the global economy that impacts ours as well. And so they always got this balancing act between inflation, employment, the various other parts of economic growth and data. They all take in and they try and decide what to do. It just shows the market isn't great at predicting this stuff. At the beginning of January 2020, the market was only pricing in a 5% chance of a rate cut by the end of January. So they weren't thinking there was going to be anything. They thought that the Bank of England was going to sit on its hands and do nothing for kind of a watching brief. Because don't forget, we've had Brexit all thrown in here as well. But suddenly, in less than a week, the odds of a rate cut at the Bank of England at the end of January, there's a meeting on the 30th of January, has jumped to 60%. So therefore, the market is pricing in that the odds are that we will have a rate cut. Now, that might change. And the reason that's occurred is because some of the data, the economic data that's come in, has been a little bit soft. And when I say soft, that means it's been weaker than people thought it would be. So in November, for example, the GDP, the gross domestic product, which we use to measure the economic health of the UK, fell by 0.3%. Now, that was way more than expected. The services sector, so that's things like what's going on in the city, accounts for, I think it's about 70% of the economy. It's a big chunk, so it's important. That contracted by the same amount. Manufacturing contracted by about 1.7%. So these are all scary numbers. And given that everybody was therefore thinking that we would start getting some kind of Boris bounce, it was more than they thought even in the lead up to the election. I mean, the good news, I suppose you can call it good news, that the economy grew between September and November by 0.1%. But of course, what happens, they tend to look at quarters, so Q1, Q2, Q3, Q4. So the October to December numbers, which will come out, I think, at the end of the month, they'll be looking at that. Because if you get contraction 2 quarters in a row, that's the definition of recession. So people are starting to wonder, will we have signs of that? So we've had no Boris bounce at the moment. So Boris Johnson's big election win hasn't had a direct impact as yet that we can see on the economy. We've got to see what happens. With inflation keeps falling, so it's 1.3%. It's meant to be 2% is the threshold that the Bank of England is targeted to keep inflation steady at. If you remember the analogy I always go on about revs in a car, if the revs get too high, the engine will blow up. The economy is the same. If inflation gets too high, the economy will blow up. If it gets too low, it will stall. Same with a car, same with the economy. So that's why they want to keep it at a nice pace. And interest rates are the gear stick that they can use to move them up or down. With inflation being continually weak, it means they're more likely to cut interest rates to stoke inflation. And with economic data being weak, they're more likely to cut interest rates to stoke growth. It helps the engine start to pick up speed. And on top of that, the other thing that came out, there are 9 people on this committee that make a decision, and 5 of them in the last week or so have made noises in the press and at conferences to suggest that they are more likely to vote for a rate cut in January. They don't say what they're going to do. They can't do that. That wouldn't be good form, would it, if you're already knowing what's going to happen in a monetary policy committee? But it's a majority vote, and people are sitting there counting the numbers up and they're going, well, those 5 sound pretty dovish, which means they're more likely to vote for cutting rates. Well, 5 versus 4, that means a rate cut's coming. So the interesting thing is that we could be looking at something like interest rates going down to like maybe 0.5% at the end of this month. If they don't, then that
you think that's far more likely than a big cut, like a 0.5% cut. That doesn't really happen, right?
Well,
it does.
It's happened in the past when the financial crisis. But I think what they want to try and do is they try and ease the economy. They try and do it ahead of time and don't want to. If they're really ramping things up or down, things have gone wrong. It's a bit like when you're driving the car. You can count on probably one hand how many times you've gone from 5th gear down to like 2nd or whatever, or up
the engine doesn't like it.
The engine doesn't like it, so they won't do it.
Yeah.
So therefore they go down. They want to go down gradually, and so they'll probably just do it just to ease it a little bit. Come on, give it a few more revs. Almost that's that kind of concept. So knock it down a little bit of a gear just to get the revs picked up again. And the market is now thinking that we're suddenly in a world that easing is going to happen and more of that. And if you look in America, they're also thinking there's going to be more of it coming. And I think it's because the economy is perhaps weaker than people expected. Now, I said there's an interest rate decision in January. If it doesn't happen then, it might not happen. We might not have a rate cut. There's not one again till the end of March. Then we're in May. Then it's June, August, September, November, December. So there's not one in October. So that's the months. I've got the dates, but it's kind of irrelevant. It doesn't matter too much. So the message is that keep an eye on inflation data. If it's starting to keep being weak, it's more likely the Bank of England will cut rates. If economic data comes out, particularly look at the end of this month when GDP data comes out. If that's weak, that's another reason. We had weak UK retail sales for Christmas come out today. They were weak. All of these things start to put pressure on the Bank of England to maybe take some action. And also jobs, because job numbers give an indication on the health of the economy. So more importantly, what's the market thinking about if we can trust these things, which I've started this piece by kind of saying you can't, but just to give people an indication what the market thinks. The money markets think the rates will be cut at some point this year, but they won't be going up in any way, shape or form, like in a serious way, for years. So if you look at like a year out, then we might be back to where we are now, but they don't think even in sort of 3-4 years that we're going to be seriously above 1% in terms of interest rates. But it's one of those things, almost as we record this, something can happen that they suddenly change that narrative. So you can't bet on interest rate moves. And the reason this links nicely to the first piece, because when people are looking at mortgages, they're going to be wondering about this. And you have to, if you're picking a mortgage, decide on what you want, whether you want certainty or you are happy with the benefits of being on a tracker mortgage. You might get a lower rate. You're happy with that. And so some people would want flexibility. I give you an example where there's a demand in the 5-year fixed arena, so 5-year fixed mortgages, and now there are more 5-year fixed deals at lower loan to values than there are at 2-year fixes. Wow. Now some of that is down to demand, because people are thinking, oh, do you know what, rates are so low, I want to fix for longer to reap the benefits. But also it's because it's become very competitive. So there was, in the 2-year space, mortgage companies went wading in there to entice people, because it's really cheap for them to obviously lend. The rates are that they can borrow at themselves are really low. So therefore they're being more and more competitive in that market. So now they're trying to compete in another market, which is the 5-year space. So you can get a 5-year fixed at 1.39% with a 60% loan to value. Now, again, those numbers will change. It depends on your circumstances. There's a lot more other things in that. There's lots of other costs involved in taking out a mortgage rather than just the headline rate. But the point is, rates are low, and at the moment, the market is betting on the fact they're going to stay lower for longer.
And moving on to the last piece, Damien was contacted by a listener, and I'll read out the message here. It's, with all the threats of the next economic crisis that is likely to blow in our faces any time now, would it not be wise to keep everything in cash? I know that no one can predict it, and that if it is indeed coming, it could be 2021 or 2022, but considering that the crash could be as ugly as a 40% drop of our investments, is it not just better to put everything in cash and just wait for the storm? So what do you think?
Now, I did a podcast a long time ago about economic crises, and I seem to recall talking about that the next one's already brewing. But the problem is you don't know really what the cause is, because they tend to be black swan events. Now, there's always going to be a 40% drop. There will be the next one. They tend to happen. They're not like buses that come regularly. There'll be set patterns, but like we think about the dot-com bubble that burst, the financial crisis, there's some form of euphoria that builds up, and there's normally some reason behind it. So in the financial crisis, obviously we know we had a lot of asset-backed mortgages and euphoria around that, and things got out of hand. If you look at what's happened since the financial crisis, of course, we've had crazy liquidity. So again, interest rates being cut. So a nice link back to the last piece. We've had, particularly in America, we've had QE, so quantitative easing, money printing. And as that analogy I always say about water in the garden, the water just runs into puddles. If you spray money onto a financial system, it ends up in risk assets. Now in America, coincidentally, you'll hear lots of stuff about repo. And to cut a long story short, there was a form of quantitative easing, but not quantitative easing. The Fed was quite clear it wasn't, that was started in October. And if you're listening to this podcast, go and grab your stock app on your phone or whatever charting thing you want to look at, and go and look at the first week of October, particularly look at the S&P 500, and the rise of the stock market is almost, well, it's a diagonal line, almost parabolic. And what's happened, the point of this liquidity was to keep the wheels of the banking sector moving for various reasons. And to understand it, you'd have to be some sort of crazy boffin. And that people talk as if they really understand what is going on, but to be honest with you, it is incredibly complex, and it goes beyond my understanding, to be quite frank. But what they're doing is they were using liquidity to keep the wheels moving overnight in the banking system, so people will be able to borrow money and temporarily, etc. The point is that we started to call it not QE and not QE4, so the fourth round of it. And if people are 80/20 investor members, they'll see me talk about it a lot. And it had the same impact. So it pushed things to a crazy level that where the market just seems to be going up on a daily basis no matter what. And we had the Fear and Greed Index by CNN. If you type Fear and Greed Index, it's something that I've covered once before on the podcast, a measure between 0 and 100, whereby they use lots of metrics to decide whether markets are being driven by greed or fear. And at the moment it's greed, and it got up to 97 about 2 weeks ago. I've never seen it that high. I don't think it's ever been that high. And so that means that everybody's being incredibly greedy. And as Warren Buffett said, yep, you want to be fearful when everyone's greedy. We don't know when the next crash is coming, but everybody's talking about it. And if you're worried about a crash coming, we're going to have one, right? Okay, that's given. But trying to market time is almost foolhardy. You will lose out in the long run. And by that I mean that if you look back to, people have been talking about crashes mostly for the last decade, and the markets kept going. And one of the biggest drivers is this liquidity. And if the central banks have our back, then it almost feels like the market's going to keep going up. It's just because it's broken. They're almost rigging it. And in 2018, when the Fed said they were going to start, they were unwinding everything, raising rates and unwinding QE, the market collapsed, didn't it, quite aggressively. And so the Fed then did a U-turn and got scared. So that is one of the reasons why it could collapse. We don't know when it will. The fact is it will do. Now, if you're worried about that, keeping your money in cash is clearly a sensible option, because the only thing that will stop you losing money is keeping it in cash. And of course, that's assuming your bank doesn't go bust, because don't forget, in the financial crisis, all the banks were going bust. So if you do that, make sure you spread it around and make sure it's covered under the FSCS scheme and all the various banking licenses, but that's a topic for another day. So you would want to keep your money in cash, but you would have missed out on a huge rally in the stock market. I mean, the market is more than doubled in that time. And you could I've known so many people who've been bearish and have sat on the sidelines. So by being fearful, it inhibits you. By being greedy, it makes you overconfident. So you need to have a process, whichever that is, to try and ensure you make a decision for a logical reason. And so if you're scared, sit on the sideline. Or if you're worried about markets falling, strategically, it's been shown mathematically that if you drip money into a market over time, then you will benefit when the market starts to fall from pound cost averaging. So as the market falls, then on the way down, when the market then inevitably rebounds, because don't forget, markets, if you go back 100 years, are going up with all these interim big collapses and everything. And over time, when they rebound, you've bought more of that stock for a cheaper price. And when it rallies, you'll be better off than somebody who'd put all their money in the day before the market crashed. So the answer is, I don't know when it's going to crash. No one knows when it's going to crash. People who tell you they do know, or selling you stuff on fear, are normally trying to flog you something else, which is some sort of investment, which I'd be wary about, and they just eat into your returns. So if you are worried, manage risk, review your portfolio, reduce risk, sit into cash, but be aware you'll never market time. So one of the best things is, and a lot of people who I know listen to this podcast who like maybe things like investment trackers and things like that, is you drip in, you do it over time strategically, and accept the fact that this is an inevitability. And just my last point before we finish, there is nothing wrong with admitting that investing isn't for you. You don't have to invest in risky assets just because everybody else does. It's your own attitude to risk. You might be happy just taking a steady couple of % a year on your investments, but then you have to accept the fact that inflation eating into your value of your money is a real issue. But that is the risk of reward of investing. You can't have all the reward with none of the risk.
And I suppose if you're worried about something eroding your profits, then you should also look at maybe trying to cut costs.
Costs, Andy, is a big one. So if you over time, it's the compounding. So all these things you would need to be aware of. Cost is one of the most effective ways of boosting your growth, because you're basically investing in the same thing but cheaper. So yeah, it's a good question. Everyone's thinking about it, and when the market does collapse, it'll be one of those things that people will say, "I told you so." But if people really believed it, they would be shorting the market. They'd be betting against it. And how many of those people who tell you the market's going to collapse are going to bet against it? And the one thing, if they had, they'd be bankrupt by now, because the market has been going up almost steadily ever since. And that's not to say the market won't pull back. It will do.
Excellent stuff. If you want to get in touch with Damien, you can do so. It's Damien@moneytothemasses.com. You can get in touch via Twitter. It's @moneytothemasses with the number 2. Also, Damien's on Instagram. We've got the Facebook community group, the Facebook page. Again, Damien mentioned the newsletter earlier. If you want to get involved on that, to get an email that sums up all of the financial news, we're talking property, we're talking investments, insurance, there's everything in there in a nice concise email. Go to moneytothemasses.com/newsletter and you'll be able to sign up for it.
Exactly that.
And lastly, if you want to grab yourself a mug, if you haven't already, do something mug-worthy, and that is review the podcast. Nip onto iTunes or your podcast of choice to review it, and get in touch with Lauren by emailing lauren@moneytothemasses.com. Damien, that's the longest summary I've done in a long time.
You've done it brilliantly. You've done it brilliantly, and almost in one take.
Almost. Until next time.
Until next time.